Hi, Zane here again with another topic. Inflation. Anchors have been saying inflation keeps rising. Alternatively, they keep saying hiring is cooling across key sectors. For months, economists have said this very thing, that the worst was behind us. But now, new data is suggesting something different. Prices are ticking up again, even as hiring slows down. It's a rare combination, and one that has both Wall Street and Main Street worried. The numbers behind the headlines: the latest inflation report shows prices rising by 0.3% in September, pushing the annual rate to just over 3.6%. That may not sound high, but after nearly 2 years of steady declines, it's a warning sign that inflation isn't going away quietly. Meanwhile, job growth has cooled. Only about 20,000 new jobs were added last month, compared to over 250,000 earlier this year. That's a slowdown that's hard to ignore. For workers, it means fewer opportunities and slower wage growth. For businesses, it means cautious hiring and tighter budgets. And for policymakers, it means trying to balance growth without fueling more inflation. A nearly impossible task. The everyday impact. Let's talk about what this means for the average American. Grocery bills are still stubbornly high. The price of eggs, chicken, and fresh produce has barely budged. Rent continues to climb, especially in urban areas where supply still can't meet demand. And while gas prices have come down slightly, they remain higher than most families would like. When wages don't keep up with prices, even small increases hurt. That's why consumer confidence, the measure of how optimistic people feel about the economy, has dipped again. Why it's happening, so what's behind this tug of war between inflation and a slowing job market? Several factors are at play. First, energy costs are rising again due to global supply concerns and instability in key oil-producing regions. Second, housing remains in short supply, keeping rents and home prices elevated. And third, many businesses are facing higher borrowing costs after the Federal Reserve's aggressive rate hikes over the past 2 years. Those higher rates are doing what they were meant to do, cooling demand. But they're also putting pressure on small businesses, consumers, and the job market. The Fed's dilemma for the Federal Reserve creates a tricky path forward. Cut rates too soon and inflation could surge again. Wait too long and the economy could tip into recession. The Fed's chair recently hinted that rate cuts might not come until early next year, depending on how these next few reports play out. That uncertainty is what's rattling investors and consumers alike. There are winners and losers in a slowing economy, and not everyone feels the same impact. Large corporations, especially those in tech and finance, have the resources to weather economic shifts. But smaller businesses, restaurants, manufacturers, and service providers often feel the squeeze first. Many small business owners are reporting lower sales and higher costs. Some are even pausing hiring or reducing hours to stay afloat. It's not a crisis yet, but it's the kind of slow burn that can lead to one if it continues. Let's look at the job market today. The slowdown is most visible in construction, retail, and professional services. Tech hiring, which boomed after the pandemic, has leveled off. Some companies are quietly reducing staff through attrition instead of layoffs. A sign that employers are being cautious but not panicking. The good news? Unemployment remains relatively low, around 4.1%. But if job creation continues to stall, that number could start to rise. So how are Americans adapting despite these headwinds? More people are turning to side gigs, freelancing, or remote opportunities to supplement income. Spending patterns are shifting too, less on luxury, more on essentials. And while optimism may be low, resilience remains strong. The US is not alone in this balancing act. Europe is facing its own inflation problems, while China is struggling with sluggish growth. The global economy is slowing, and that interconnectedness means what happens abroad can quickly ripple back home. So where does this leave us? Economists are divided. Some say we're heading for a soft landing, a gradual slowdown that avoids a full recession. Others warn the signs point to a harder fall, especially if inflation keeps edging up. Either way, 2026 is shaping up to be a year where policymakers, businesses, and households alike will need to make tough choices. So what is the takeaway here? The takeaway is this moment is a test, not just for the economy, but for confidence. If the Fed can steer inflation down without crushing growth, it'll be seen as a success story. If not, Americans could be facing another round of economic uncertainty, just as the next election season ramps up. All in all, inflation edges higher, job growth cools, and economists debate whether a soft landing is still even possible. The numbers tell one story, but how they're managed will tell the next. Stay tuned, stay informed, and remember, the story isn't over yet.